A lot of owners and entrepreneurs hear that from financial investors or private equity firms, or they might hear it from Wall Street. It's a term, an accounting term that was made up. EBIT stands for earnings before interest, taxes, depreciation, and amortization. The reason why this was created was that financial investors on Wall Street really wanted a standard term or standard format to measure cash flow. Let's see. What are the components of cash flow? Cash flow, of course, are the earnings. But you add back interest, because interest could be interest you pay for debt. So interest and taxes you want to add back to earnings to get cash flow. And depreciation and amortization are accounting items that are non-cash accounting items. So even though we subtract it out of income statement that are or non-cash items, you want to add the cash items back so you can have a better idea of what the actual cash flow is. Our owners have personal expenses that potentially run through, or non-recurring expenses that run through. So adjusted EBITDA is something that you would adjust it, so going forward those earnings before interest, taxes, depreciation, and amortization would perhaps be higher. And why do financial investors and private equity take a look at EBITDA? Well, because they want to measure the different multiples on that. A slow-growing company could have a multiple or enterprise value of multiples off of the EBITDA of anywhere between 3 and 5 times EBITDA. A moderately fast-growing company could approach 6 to 7 to 8 times EBITDA. An extremely fast or high-growth company can command a multiple in the 10 to 12 range. Some of the much fastest-growing multiples can approach multiples in the teens. Companies growing that fast. So that's one way to measure enterprise value. And then enterprise value can, once you have enterprise value, let's take a simple example. If you have a company having $15 million of adjusted EBITDA and they're not growing as fast, they perhaps have a 4 times multiple, so 15 million times 4 is $60 million. And then you add the cash that they have on the balance sheet, that perhaps it's $10 million of cash, and 60 plus 10 is $70 million. And then you have to subtract off the debt. So if they have debt of $40 million, 70 minus 40 is a $30 million equity value. Certainly tons of other ways to value a company. This is sort of a back of the envelope rule of thumb that a lot of financial investors on Wall Street use. Of course, they're running discounted cash flow. That's where you project out all the cash flows ad infinitum and then apply a discount rate to those cash flows to get a cash flow value. And then there are comparable values. And this is where companies look at not only comparables as far as PE comparables, revenue comparables, of course the value by subscriber, by customer, by views, who knows. There are lots of different ways to value it, but at the end of the day, you're going to look at comparables or market comparables. What are other companies trading for? What are other companies selling for in the marketplace? What are the other market comps out there, whether it's 3 to 5 times EBITDA or 7 to 9 times EBITDA? They want to make sure that they're certainly not overpaying. Everybody wants a good bargain. Everybody wants a good investment. What you want to, as a company owner, an entrepreneur, you of course certainly want the highest value you can get, but you shouldn't only look at value. You should look at what the financial partner or financial investor or private equity firm is bringing to the table. They may be bringing other resources, other value-added services, and those are the things you should be looking at besides just the value of the company.